Tyler, it's really changed over time as the market has continued to really increase. When I started my career over 20 years ago, when we're talking about mid-cap stocks, we talk about 5 or 10 billion. It's really no longer the case today. You've got to start at that low end around 5 billion, but you're really going up into the 30, 40 billion dollar range to really define that mid-cap range.
Yeah, these stocks, obviously, as capitalizations have grown, the upper bound has gotten higher. What about them, and what about value stocks in this bracket are so appealing right now?
So there's really two different questions in there, Tyler. First of all, what's attractive about mid-cap stocks? They're really in the sweet spot. They're survivors. So they've gone from being small companies to mid-cap companies, which means that they're offering some kind of product or services to their consumers that they really want. They're going to grow faster than large cap companies, but they're going to have better balance sheets and typically better returns on capital and better scale than their small cap brethren. So those are attributes that make them more attractive in that mid-cap size relative to small caps and also to larger caps because they're growing faster. But also there's a consequence or a positive outcome sometimes, and that's their acquisition targets for larger cap companies because they're growing faster or they fill some kind of niche. So,
and let's give a couple of examples.
We don't buy them for our customers, but that's what they end up happening.
Exactly. A couple of names, Michael, that you're pointing out in particular that we have here: Advanced Auto Parts, Zimmer Biomet Holdings. They make artificial hips and knees. Also ConAgra Brands. And I wonder if you could explain why you like ConAgra Brands in an inflationary environment and how long you expect that inflation to persist.
Sure. So we're not exactly sure of how long the inflationary environment will take place. It could be 6 months. It could be 6 years. We hope it's the shorter and not the longer. But regardless, ConAgra, which is a manufacturer of packaged foods, and they've got strong market shares that we think are fairly defensible across multiple categories. Look, the inflation is there, but we think that they're going to be able to offset that with pricing power, albeit with a lag, because their peers are going to have to raise prices as well. And that's going to give them the room to be able to raise their prices as well. So the company has a pretty good balance sheet, a 3.8% dividend yield. And we think that their pricing is going to catch up with the supply chain induced inflation, but it's at a pretty cheap valuation.